The broadcast is now starting. All attendees are in listen-only mode.
Good day, friends and traders. My name is TIAN, and I'm your host for today's UTP lesson on Fibonacci's and the auto Fibs. Thank you everybody for joining. Today is Monday, the 6th of February 2017. Can I please confirm audio and visual before we continue with the lesson? Thank you, Bill. Thank you for joining. Thank you everybody else. Right, now I'm going to go through the manual here, but if you have any questions, please stop me, let me know, and we'll jump to the charts, and I'll explain what we see in the manual. Okay, right. Extensions and retracements in an uptrend. Now, first of all, I'm going to explain the market retraces inside the AB boundary, and then how the market moves to the D extension, and then we're going to have a quick look at drawing and adjusting trend lines. Right, now all movement is motion and energy. The deeper it goes, the less energy it has to bounce back up. So if you see a deep retracement, then potentially the market will consolidate. To give you an example, let's open up a new workspace over here. Oh, there's another workspace. Let's try this one. Take any chart. Like that. If you have an up AB boundary, change the font here. And the market moves and establishes the A and the B, and then the market starts to retrace but gives you a deep retracement. Right. There's not enough energy to provide the market enough momentum to actually come and hit the 1.618. That's why the D extension will be the 1.18 extension over here. There, 1.18. Okay, so chances are when you get a deep retracement like that, then the market will only move to the 1.18 extension, and guess what? It indicates consolidation. Look at that. Type a wire yes if you're with me up to this point. When the market gives you a deep retracement, it's impossible to give you a much higher extension. Therefore, the D extension will be the 1.18. Everybody with me up to this point? Okay, fantastic. Right, now if you get a shallow retracement, then the market is expected to move to the 1.618. To give you another example, there we go. That's an example of a deep retracement. And here's an example of a shallow retracement. Okay. A, B, C, D. There's the AB boundary, and now the market only retraces to the 382 or the 50 or the 618. Therefore, chances are the market will go and hit the 1.618 over there. Right, that will be the D extension. A, B, C, D, and again A, B, C, D. Right, this over here resembles a strong trend, and this over here resembles a weak trend or even consolidation. Okay, doesn't have the strength to go and actually hit the 1.618. Right, please type a DONE done when you've copied this down. You're more than welcome to take a screenshot for your own reference. But copy this down. This is very important moving forward. Do we have sound? Testing 1, 2, 3. This is a test. Testing 1, 2, 3. Do we have audio and visual? Okay, beautiful. Okay, just thought I got lost in translation there. Okay, thanks Marinda, Tom, Michael, everybody else. Right, let's carry on. Now here's some Fibonacci retracements and extension relationships in an uptrend. Now the deeper the market retraces, the less energy it has to rally. And that's what I just explained. Here we have an AB boundary. The market retraces to the 382, and then the D extension will be the 1.618. Right? Here we have a second example, AB boundary. The market retraces to the 50 retracement level. Therefore, the D extension will be the 1.618. And also, if the market should retrace to the 618, the D extension will be the 1.618. Okay, alternatively, if you get a much deeper retracement to the 786, then the D extension will be the 127 extension. Also, if you get a deep retracement to the 86 retracement level, then the D extension will be the 1.18. It doesn't have enough energy to actually go and hit the 1.618. Right. Also, if the market bounces off the A or give you a much deeper retracement, then the D extension will be the 1.618. Right. Now, there are no absolutes in the market. You cannot use the words always, every time, or never. The market will do what it wants to do when it wants to do it. It will do it, and it will always be right, because the market is never wrong. Now, there are primarily 6 different ways the market retraces back into the AB boundary. So there you have your AB boundary, A and B. Then the market retraces to give you a C, and then after that moves to the D. But there's 6 different ways how the market could retrace back inside the AB boundary. There we go. There we go. Right, so now we have an A. This is example number 1. We have an A and a B. There's the AB boundary. And then the market retraces and gives a super shallow retracement. It never gives a deep retracement. In that event, the D extension will still be the 1.618. Right, then you get another example where you have a shallow retracement, where the market actually, first of all, gives you a super shallow retracement and then bounces against the 127 extension. Because the 127 extension will be hidden natural resistance. Then the market comes down, gives you a deeper retracement, and then moves to the D. You also have another example where the market should give you a much deeper retracement past the 50. Another deep retracement like that, first bounces against the 382 and then comes down to bounce against the 618, or give you a deep retracement to the 786 or the 86 retracement level, or alternatively the market can become whippy, lashy and nasty inside the AB boundary, okay, and remain there for quite some time, whiplash up and down, before the market hits the D. Right, now there are primarily 6 different ways the market moves to the D extension. Here we have an A, B boundary, the market now retraced to the C, and now you have different ways that the market will move to the D extension. There we go. First of all, there's the AB boundary. The market retraces to the 382, therefore the D extension will be the 1.618. Also, if the market moves to the 618, the D extension will be the 1.618, or the market can bounce at the 618 and then move up to the 127 extension, bounce against the 127 extension, retrace a little bit and then go to the D. Market may also first give you a deep retracement to the 618, then bounce against the 127 extension, and then after that start to retrace again before it goes up, or the market might just trend all the way to the D, or become whippy, lashy and nasty all the way to the D extension. Okay, now the average distance between a C to a D in an uptrend on a 15-minute chart is 45 pips. On a 30-minute chart it's 90 pips. On a 60-minute chart it's 180 pips. On a 2-hour chart it's 240 pips. On a 4-hour chart it's 300 pips. And on an 8-hour chart it's 420 pips. On a daily chart it's 600 pips. On a weekly chart 1,500 pips. And on a monthly chart it's 2,400 pips. Right, note the distances between the C to the D will depend on the average daily trading range. The smaller the daily trading range, the smaller the distance between the C to the D. The larger the daily trading range, the larger the distance between the C to the D. Now these numbers are estimates for example purposes, and actual numbers may vary because of the daily trading ranges that may differ. So for instance, the daily trading range on the pound New Zealand dollar will be much higher than the daily trading range on the euro pound, because it moves more than the euro pound in a day. Right, auto up ABCDs. First of all, compress the chart. Find the lowest low on the chart, which will be the beginning of the new uptrend. Click the auto up ABCD tool on that low. If a green and yellow box appears at the current market, the market is in an uptrend. If it does not, then the market is, or the current market is in a downtrend, making lower lows, and you will need to find the high of reversal and click on the high to identify the down or the new downtrend. Look at that. Okay. So first of all, identify a trend and then start your Fibonacci's at the low of that current trend that you've identified. If you do not see an up ABCD that's intact, then the market is bearish and you have lower lows. Then look for the highest significant turning point and put your fibs at that high. Right, let's look for an example. What's currently in an uptrend? Let's take maybe the NZD US dollar. Let's have a look here. There we go. Right, so there's the uptrend. Start your fibs at the low. And there we go. There's the most recent up AB boundary on the 2-hour. This means the market is in an uptrend. Alternatively, if you don't see anything like this, then the market is most probably making lower lows and lower highs. Therefore, you need to start your fibs at the high to indicate the down Fibonacci's. Okay. Right, auto down ABCDs. Press the chart, find the highest high in the chart, which will be the beginning of the new downtrend. Click the auto down ABCD tool on that high. If a red and yellow box appears at the current market, the market is in a downtrend. If it does not, the current market is in an uptrend, making higher highs, and you will need to find the low of reversal and click on the low to identify the new uptrend. Okay, so first step, open up your new chart. Let's take any chart. Let's take the pound Canadian. I can open up a 2-hour and compress the chart and ask yourself, what is the direction of the most current trend? Is the market in a downtrend or is it in an uptrend? If the market is in a downtrend, start your Fibonacci's at the high and look for the most recent down AB boundary. There we go. Right. Now we get to drawing up trend lines. Now there are primarily three uptrend lines formed in an uptrend. An inner trend line, an outer trend line, and a long-term trend line. Draw uptrend lines across the lows of support connecting A's and C's after a new high has been made. Right, draw uptrend lines across the lows of support connecting A's and C's after a new high has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or lowest low with the next higher low. The outer trend line is drawn starting with the previous low above the long-term trend line, moving it forward till the line hits the next low. An inner trend line is drawn starting with the previous low above the outer trend line, moving it forward till the line hits the next low or connecting the most recent A and C. To give you an example, look at this. I think we're going to have to open up a daily here. There we go. Clearly the market is in an uptrend. So if I start my first trend line at the bottom, then that will be the long-term trend or the long-term outer trend line. This will be the outer trend line. There we go. And that will be the inner trend line. Now we can see that the market broke the inner trend line to the downside and then moved all the way to the outer trend line. Now the market has broken the outer trend line and now it could be moving to the long-term outer trend line like this. Market breaks the inner trend line, moves to the outer trend line. There. Breaks the outer trend line, comes back to confirm the break potentially, and then moves to the outer trend line. Okay. If the market should break the long-term outer trend line like that, then this will be your new down long-term outer trend line. Let's change the color of that one. Like that. Okay, is everybody with me up to this point? Please type a wiry yes. Okay, fantastic. Thank you, thank you, thank you. Right, now the first step to finding and drawing correct uptrend lines is to first compress your charts and find a trend reversal where the market has broken a downtrend line and is now making higher highs and higher lows. First step to finding and drawing correct uptrend lines is to first compress your charts, find a trend reversal where the market has broken a down trend line and is now making higher highs and higher lows. Right, the lowest low is the starting point. This is what we refer to as the lowest significant turning point, the lowest low that the market made before it broke the downtrend line to the upside. Right, there we go. There's the long-term outer trend line, the outer and the inner trend line. And now we get to extensions and retracements in a downtrend. Now I'm going to explain now how the market retraces inside the AB boundary and how the market moves to the D extension, and then also drawing trend lines. Right, now there's a phenomenon in the market. As the market moves down, it moves in the same numerical sequence as an uptrend, but in the opposite direction. Fibonacci retracements and extension relationships in a downtrend. The deeper the market retraces, the less energy it has to rally. There we go. AB, the market retraced to the 382, right? And it's got a very good chance of moving to the D extension. Also, if the market retraces to the 50, the D extension will be this 1.618. Also, if the market retraces to the 618, the D extension will be the 1.618. Alternatively, if the market should retrace to the 786, then the D extension will be the 127 extension. And then also, if the market should retrace to the 86 retracement level, the D extension will be the 1.18. Right. Now there are primarily 6 different ways the market retraces back into the AB boundary. There we go. We have an A and a B. We can have a super shallow retracement, but then the market's got a good chance of bouncing against the 127 extension. Alternatively, you can have a super shallow retracement and then the market bouncing against the 127 extension, then coming back for a shallow retracement, and then after that heading to the D extension. Also, you can see the market give you a deep retracement past the 50 retracement level. Also a D extension where the market should wave, first bounce against the 382 and then eventually give you a deeper retracement. That's why I don't want to sell when the market hits the 382, because you could be seeing a deeper retracement. Also, the market could be waving inside the AB boundary all the way to the 786 or the 86, and then you can have a whippy-lashy nasty movement inside the AB boundary where the market is just going haywire, up and down, eventually gives you a C and then moves to the D extension. Lots of indecision. This means lots of indecision. Right, now there are primarily 6 different ways the market moves to the D extension. As the market dips, creating a down ABCD price swing, it has 3 different natural levels of support. First support will be the B low. Next support will be the 127 extension. And then the next support will be the 1.618. There we go. As the market dips, creating a down ABCD price swing, it has 3 different hidden natural levels of support. Look at this. Down AB, the market only retraced to the 382, then came down, bounced against the 127 extension, and then after that moved to the D extension. Okay, so first support at the B low, then support at the 127 extension, and then support at the 1.618. There are predominantly 6 different ways the market can move to the Fibonacci D extension in a downtrend. So there we have the market retracing to the C from the 382, move all the way to the D extension. But before that, we had a super shallow retracement and the market bounced against the 127 extension, came down eventually for a deeper retracement before the market moved to the D. Here we have a 618 retracement. From there the market moves to the D. We also have a 618 retracement, a deep retracement, but potentially the market could be bouncing against the 127 extension, then pull back a little bit before it moves to the D. Alternatively, if you have a deep retracement, the market could come down, bounce at the 127 extension, then come back to the 382 before it moves to the D, or it can just wave to the D extension, or become whippy nasty inside the AB boundary, and eventually give you a deep retracement, and then after that move to the D. Right, drawing down trend lines. There are primarily three down trend lines formed in a downtrend: an inner trend line, an outer trend line, a long-term trend line, and then draw down trend lines across the highs of resistance connecting A's and C's after a new low has been made. So there's the long-term outer trend line, and the inner trend line. Draw down trend lines across the highs of resistance connecting A's and C's after a new low has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or highest high with the next lower high. The outer trend line is drawn starting with the previous high below the long-term trend line, moving it forward till the line hits the next high. An inner trend line is drawn starting with the previous high below the outer trend line, moving it forward till the line hits the next high, and or connecting the most recent A and C. Michael says if the market has made a bullish direction, two higher highs and higher lows, and then making a new higher low but not a higher high, then you can't connect the lower lows with a trend line. You can. Your question is this. Let's do this quickly. If the market makes two higher highs and higher lows, there's a high, there's a low, there's a higher high, and there's a higher low, like that. Higher highs, higher lows. Two higher highs and two higher lows. Right? But not a higher high. Then you can't connect the lower lows with that trend line. So if you don't have a higher high, if the market hasn't made a higher high, no higher high over there, then you're going to have to start your trend from this low over here. Like that. If you don't have a higher high, then you cannot start your trend over there. You need two higher highs and higher lows. Does that answer your question there, Michael? Okay, fantastic. So in a nutshell, this is wrong. But this is right. Okay. First step to finding and drawing the correct downtrend lines is to first compress your charts and find a trend reversal where the market has broken an uptrend line and is now making lower lows and lower highs. First step to finding and drawing correct downtrend lines, first compress your charts, find a trend reversal, there we go, highest significant turning point, and then you can start your uptrend line. Over there you have lower lows and lower highs, so there's your downtrend, and there we go. So that would be a long-term outer trend line, this would be the outer trend line, and that would be the inner trend line. If the market breaks the inner trend line, then it will move to the outer trend line. Right, draw down trend lines across the highs of resistance connecting A's and C's after a new low has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or highest high with a high that hits the line. The outer trend line is drawn starting with the previous high below the long-term trend line, moving it forward until the line hits the next low. An inner downtrend line is drawn starting with the previous high below the outer trend line, moving it forward till the line hits the next high and or connecting the most recent A and C. Right, that now concludes our lesson on trend lines, Fibonacci's and auto Fibs. To give you an example, let's choose a currency pair. Let's take any one. Let's take the, you can choose one. Type a currency pair in your chat box. And then we have a look at the auto Fibs and the trend lines. Michael says NZD USD. Alright, let's open up NZD USD, open up a daily chart, and there we go. Right, compress the chart. What would you say? Is the market currently in an uptrend or a downtrend? Uptrend, right? Because that was the previous downtrend, and now the market broke the downtrend to the upside, so this is the most current trend, this uptrend here, and that would be the lowest low where I'm going to start my Fibonacci's. Right, so let's have a look at this. There's the up AV boundary, there's the uptrend line, that would be the outer trend line, or the long-term trend line, that would be the outer trend line, and this would be the inner trend line. There we go. Long-term outer trend line, and this would be the inner trend line. There we go. And there we go. Now as the market moves, breaks the inner trend line and the outer trend line, it moves back inside the AB boundary, and either going to give you a deep retracement or a shallow retracement. Right, but there we go. Market is clearly in an uptrend. There's the uptrend. And there's the auto Fibs. Okay, did you guys enjoy the lesson? Oh, fantastic. Thank you, Michael. Thank you, everybody. I'm going to take a 15-minute break, and then I'm going to get then I'm going to start the analyst on demand again, and then we can carry on trading the live market. But as usual, thank you everybody for joining me for today's UTP lesson. Fantastic. Thank you, Stan. All right, guys, I'll see you in a jiffy. Cheers.